Okay, Melissa. Well, thank you for having me. Love to just, I understand that you got a client
Yep.
or you've got a client scenario that you want to work through, and
Yeah.
I'm happy just to walk you through our process and show you the way that we think about investor scenarios. As a wealth management office, we generally get to know an investor pretty well before we'd ever make a recommendation into a specific offering.
hmm
But based on what you know about your client, we can at least frame up some options. So, yeah, tell me a little bit about your client. What's their situation? What are they trying to do? What do they have? We can go from there.
Yeah. So there's multiple properties. There's one that we looked at specifically that, let's just say for the sake of keeping numbers round, that we've got $1 million home that they're
Okay.
sitting on. And they're tired of being a landlord. They're kind of jaded on being a landlord for all the reasons.
Mm-hmm.
And we're just looking at ways to come up with a plan for them to 1031 into the next best thing so we can completely avoid paying tax on that. And we're also looking at we're just looking at all the things. So
Sure.
I'll let you take it from here.
So it's an investment property, right? So they don't live in it. They've got
Correct.
Renters. Is it a single family home?
Yes.
Okay.
Yeah, they rent it out. Yeah.
They rent it out, and they're, for one reason or another, their management burdens are just not aligned with their phase of life, which we see that a lot.
Right.
So generally, when we're planning for this type of an investor, the goal is to take risk, take level of effort, take personal involvement off the table by selling what they currently have, and then trying to identify an opportunity for them to reinvest through the 1031 exchange into something else that can eliminate or at least reduce their management burden. So if that's a number one, I would actually say, for us, we never want to pay taxes if we don't have to. So the first thing is to defer tax. That's always goal number one. There's a lot of opportunities to invest in real estate. If you do have a tax deferral opportunity through the 1031 exchange, I think it does change your scenario and your goals just a bit. So we want to reduce management burdens. Are they about how old are your clients? Are they in their 60s, 70s, 80s?
70s.
Okay. So, oftentimes for someone who's in their 70s, what they've likely done is they've accumulated wealth through real estate.
Yep.
They've worked really hard. They've spent their weekends, their holidays. They probably included their kids in ripping out carpet, replacing bathrooms. A lot of these folks that we talk to, they're the blue collar millionaire. They're these people who, at a dinner party, you may not know that they have $5, $6, $7, $10 million worth of wealth accumulated in these projects, over their lifetime, especially our California clients. What we want to do is we want to take all of that hard work and we want to protect their capital. So that, I think, is a number 3 goal underneath of, reducing management burdens. If these two things are driving us in a direction, we want to make sure that their capital is protected. And oftentimes, what comes next is stability of income. So I can spell your income. Most folks, when they're working with their financial planner, which, by the way, I'm sure you'll get to know over time, but their financial plan depends on a certain level of income. And we always want to know how much of that income is coming from your investments, and specifically how much of that income is coming from your real estate investment. And so we never want to put somebody into a position where their income is jeopardized if they're dependent on it. We never want to put them in that position whatsoever, but we want them to understand the difference between a real estate project that's stable versus a real estate project that's built for speculative growth. And so that's kind of, I'll just put this way down the list. I think for my 40-year-old and 50-year-old investors, this would be higher, but speculative growth typically depends on the ability to capture potential that is not guaranteed, right? So we've created potential by either buying at a discount, or we've identified a rental property that it's a fixer upper. We need to improve the property, recharacterize the property. Perhaps the current tenants, their rent is well below the market average. And so if we can buy something and effectively manage it going forward, then we can re-underwrite the performance of the asset over time. So, knowing that, let's dig back into the investor's property that they're selling. So let's say it's worth $1 million. Do they have a mortgage on the property currently?
No.
So zero mortgage. Do you have any idea? I'm going to jump over to their tax scenario. We'll just talk about this one particular property. I know you do a really great assessment where you can look at their entire portfolio and you take all these different variables into consideration. How much are they paying for rent, or how much are they getting for rent, and how much are they paying for different expenses and property management, and what's their debt service cost, all of this. But we'll skip that for now. No mortgage. Do you know how they own this property? A lot of times it might be granted to a trust for a 70-year-old investor, or it could be in an LLC. Do you know how they take title?
Trust.
Okay. So anyone who says individual, usually I ask, is there a trust in play? Do you have an estate plan? I think any real estate investor who's over the age of 70 certainly ought to be thinking about long-term estate planning. Do you know approximately how many years ago they bought this property?
I think it said like 14, something like that.
All right, so we'll just say they bought it in 2010 for rough numbers. And do you know what they paid 14 years ago for the property?
$70,000.
$70,000. That is a good deal. So assuming that they bought the property, so how long ago did you say that they bought it? 20 years?
14.
14 years ago. Okay, so 2024, 2010. So 14 years ago, it's a residential property. They've been able to depreciate, assuming that they have done this. They've depreciated this particular property for 27 years. So their tax basis is not what they purchased. It's what they've depreciated down to. Do you know, have they put significant capital to work in this property? Have they done any major renovations that have added to the tax basis? New roof, new foundation, HVAC, something that they wouldn't have taken against their current year income, but added to the basis?
They've done general upkeep, but they haven't done anything major.
All right, we're just going to be conservative, and we'll add back $20,000 over the last 14 years.
Okay.
Is this a married individual or a single?
Yeah, married.
Married in California. The reason why it's helpful for us to know adjusted gross income is because we want to understand what is your tax liability. That's what we're really driving towards, is to understand what's your capital gain rate. Oftentimes, I mean, an investor who is selling an appreciated property over $500,000 is going to trigger, significant state and federal. So we're going to max this person out just for the purposes of this demonstration and presentation. So we're going to say, for a California investor, your federal cap gains rate maxes at 20. Your state income tax on capital gains actually maxes out at 14.4. Now it's a graduated tax bracket. I'm just going to model this at 10. They don't have any debt. Their federal income tax bracket is 32. We'll say, for purposes of this. And by the way, Melissa, this is something that, we're not a CPA here. We're trying to do what I'll call hand grenade math. So, if you were to kind of frame this up, this is not accounting advice. This is something that we produce as a back of napkin rough estimate and then give to an investor to take to their CPA and get an official, opinion on, and then we can come back to this. Oftentimes we'll get to know their CPA pretty well. We'll come back to this and we will modify these numbers. So with this worksheet from Wilma Flintstone, we're just trying to figure out what is their tax bill. So we can, bottom line this real quick, but just so that your audience knows, If we're assuming a federal rate of 20%, we're going to add 3.8% to that as a Medicare surcharge. And then there's depreciation recapture, which is another 5% on top of whatever's been depreciated.
Yep.
So if we add it up, we're paying federal cap gains in Medicare, we're paying depreciation recapture, and we're paying state income tax, or we're paying state capital gains at income tax rates. So tax bill, $300,000. They have an option here, and we always like to understand what is the option. So option one is do nothing. Take your $940,000 that's left after you pay closing costs. Then you pay a really, really big exit tax, exiting real estate tax of $300,000 in capital gains. That $300,000 represents 32% of all of the money that you've been able to accumulate in equity over the time of holding this property. And you'll have $638,000 to reinvest somewhere. We can agree that likely this investor needs to reinvest this money to either generate income or to protect capital. They're likely not going to just stuff it in a checking account. And so
I would tend to agree, but you know.
They could, right? But oftentimes when we're comparing, should you or should you not do the 1031 exchange, that's where we're bringing the financial plan into play. We're working with the financial advisor potentially. We're gathering quite a bit more information, but this is a good example of just what's left and what's not. If they were to do a 1031 exchange, they would need to replace $940,000 worth of property.
Yep.
And you could take them to the local market, and with $940,000, assuming that they're financeable and it aligns with their goals, and et cetera, you could start to shop for a, $4.7 million property.
Yep.
If they were going to, that's buying power that's created through the 1031 exchange, not necessarily advisable. I'm just talking about what's lendable, assuming 20% down. The net equity to reinvest, if you were to plow that back into real estate, you can see your buying power is greatly diminished.
Yep.
DSTs we can talk about. They're generally more conservatively leveraged. It offers an opportunity for an investor to go into something that's stabilized. It's institutional real estate, but they're not gonna take 20% down, 80% leverage opportunity most likely. So we're just going to assume that buying power is obviously significantly reduced. Now, what I want to kind of frame up is for my investors who are sensitive to cash flow, they're looking at bottom line, what can I make in real estate? And this is where you really need to do your homework and understanding the potential of an investment property that you're evaluating. What's the rent? What are the expenses? How much are you paying? What flows through to you at the end of the day? We're going to use 5% as a general number. Okay, I'm not talking about a specific investment, but this is pretty conservative. I think most real estate investors would say we can beat this, perhaps if we're willing to take some risk or have an advantage buy. But I think most would say this is achievable. Okay, so very realistic. I used to put 5.5 over here because it was like a standard money market account like 3 months ago. So this is where we were February 2024. So, the money market accounts might be around 5%, but I think it's common advice as people are looking at making a significantly large financial decision, and they might say, hey, I can get 5% in real estate, and someone else at the golf course or their friend from wherever, family member, would say, well, I get 5% in my money market account. The answer to that question is, well, yeah, but you're getting 5%. Let's just make it even. So you're getting 5% on less money, right? You're getting 5% on 638 instead of 940. And it will take you, Mr. Fred Flintstone, 16 years of income to make up the tax loss that we're paying here. And that accounts for paying income tax on the income that you're generating from your money market account, right? So it's a long time just to climb out of the hole that you put yourself in to get right back to where you started. So that's why for an investor who has real estate that's appreciated, it's really, really valuable for them to consider strongly a conservative 1031 exchange investment as opposed to a significant tax loss, because you can just see the power of what you're able to compound and the potential opportunity lost in terms of time.
Right.
Cash flow over 4 years, we could set this arbitrarily at whatever we want. I think an aggressive real estate investor would look at buying something, holding it, and then selling it, within 4 or 5 years. So that's why that's there, but that's somewhat irrelevant. Cash flow potential. The other thing to take into consideration is that real estate's not just advantage from a capital appreciation and transition through the 1031 exchange standpoint, but it's also valuable through income. So all of us who invest in real estate enjoy tax advantaged income. For high income earners, or it doesn't matter, any type of income earners, we're paying our income tax on less than 100% likely of our real estate investment that we're invested in, because we can depreciate the value of the asset. And so if we were to go into a 1031 exchange, we're just going to assume conservative, 60% down. We're going to take on a debt of 40%, so fairly conservative. We will carry forward $54,000 worth of loss, and we'll take on approximately $800,000 worth of basis. It depends on the property. We'll work with your CPA, but these assumptions being known, what does that actually do to your world? Well, annually, your income's $47,000. In this new world scenario, you're taking $24,000 of that income and moving it over here into this tax sheltered, protected area of, basically like a non-income distribution, or it's an expense on your Schedule E that you'll take against your income. You've been doing this for years with your other property. And so instead of paying tax on the full amount, you're paying tax on a partial amount. So let's go back over here to our money market friend who's only making $30,000 a year instead of 47. They're paying actually $13,000 worth of taxes instead of 10,000. So it's a really interesting scenario. So if you look at that, there's a tax equivalent yield. It's like, what would I have to get in my money market account to actually take home? It's not what you make, it's what you keep. Just again, we're showing the power of a real estate investment, both on capital growth and protection, but also on income. And then what would you have to do in the market to recapture that $300,000 loss over 4 years and annualize a 5% cash on cash return? Almost 20% IRR, compounded at 20%. And that's a home run deal. If you can do that, that is phenomenal. So that's, generally speaking, what we're doing in a first phone call or meeting with an investor, is trying to understand, do you have a potential reality here where the 1031 exchange makes sense? I can show you, I did this in a couple weeks ago, 4 weeks ago, with an investor, and we ended up with this number here. This is sort of like my litmus test number, 32%, right? 300,000 to 940. I ended up with a number of like 8%. Okay, so there was, in my opinion, a much less valuable reason for them to do a 1031 exchange. Yeah. And we actually advised them out of the 1031 exchange. They paid their tax, they took possession of the capital, they paid their 8% exit charge. Okay, but now guess what? We get to still go buy real estate, right? But our buying power is almost the same. We need to see some advantage here to justify not necessarily a real estate investment, but a real estate investment that's constrained to a 45-day window of identification. So, that's another interesting scenario. Something else that's nuanced here is, you want to know, let's just say that this was a bigger number. Instead of 70,000, let's say that this investor spent 500,000 on their property. Okay. So now they've actually depreciated a whole lot more of that original 500,000 against income going forward. Their tax scenario, let's just quickly look and see how that changes their tax scenario. So instead of $300,000 tax bill, it's a $241,000 tax bill. And then if we look at their comparables, right, it's 25% of their total rather than 31% or whatever it was before. It's still justifiable, okay? But now look what happens to their basis. They get quite a bit more carry forward basis in addition to their new basis. And that positively impacts their financial situation. And then let's just run it one more way. Okay, so a lot of people have a mortgage on their property. Let's say in 2021, mortgage broker called Fred Flintstone and said, hey, rates are near zero. You can be on a 30-year fixed rate mortgage at 3.2%. He says, that sounds great. And they evaluate the property and they say, hey, you can pull actually $500,000 out. So that's their original purchase price. This is how a lot of us grow our real estate wealth, right? We add value, we appreciate, we refi capital out, we redeploy that capital somewhere else. So let's say that was the scenario here, and I'll put this back for your before I send this to you, but just to see the difference, we go back to this 1031 comparables piece. Well, look what happens now. So we only have $440,000 worth of proceeds from the sale, but our tax bill is the same. It's $241,000. So now look what that does to our percentage. That's over half of our wealth that's stored in this real estate investment is lost to taxes.
Yeah.
So, these sorts of things are pretty powerful and pretty well important to understand from the investor's perspective. And I do think it takes walking somebody through their scenario like this for them to really appreciate the power. It's really like the opportunity that they've created through the risk that they've taken, through their expertise, through the work of their hands, through your expertise helping them 14 years ago identify a great opportunity to buy an investment property, right? So all of that taken in consideration has created this great opportunity. And so now it's just how can we compound good opportunities and make a good decision to create another good opportunity into the future. Maybe one more nuance here, a question to ask is like, when you bought this property, did you buy this with cash or did you buy this with 1031 money? Because if you bought this with 1031 money, your cost basis would actually be much, much, much less because it goes all the way back to your original investment in real estate that sets your tax basis and depreciates from there. And so that's, again, I think what we're trying to do as a real estate planner is to empower our investors to work with their professional relationships, their CPA, their financial advisor, the real estate professional, a wealth management officer who understands maybe a different type of real estate investment.
And the trust attorney.
And the trust attorney, yes, absolutely. To come together and really say, like, how can we steward your financial plan together through this late stage wealth management, chapter. Most of the time, our motivation changes. When we start in real estate, we are trying to, maximize what we have. We're trying to grow our real estate portfolio. We're taking big moves. We're taking advantage of refi and redeploying. We're working hard to recharacterize a property by maybe investing additional monies into upkeep or renovations or whatever. But at some point, our motivation shifts. And what we really want is we want to stabilize and secure what we've built and prepare that for transition to, the 3 C's, I'll call it, like our children, our church, our charity. All of that tax that we talked about here that we've accumulated, 241,000, the previous scenario, 300,000, all of that money is either going to go to your children, your church, your charity, or the government in the form of taxes. You get to choose. And the way that you choose is by continuing to stay invested in real estate, continue to do the 1031 exchange going forward. And when you pass away, right, if your estate plan is set up correctly, your cost basis steps up to the fair market value of your asset on the day that you pass, and your trust kicks in. Your beneficiaries receive, whatever their divided interest is of your trust, and they can liquidate those assets at a tax basis that equals the current value, which means there is no capital gain there. And so that's a really, really powerful tool. That, like, I look at this number as somebody's money. It's right now you are stewarding it as an investor. You get to use it wisely as an investor. You also ultimately get to determine where it goes. And the path of least resistance is it goes to the government. But working with us, Melissa, working with you, again, just having a holistic plan around this phase of life, that money should go to a place that you choose through an estate plan. So that's
we call it creating a legacy. Yeah,
absolutely. Let me put this back to where it was, $70,000 purchase and no mortgage.
Oh, you put it at 700.
That's a little bigger. Okay. So again, what we would do next with your investor, I'll send this to you. You're going to give this to your investor. They're going to take it to their CPA. They're going to say, hey, how does this look? And let's game plan it. Work with your CPA before you sell a property, please. Work with your wealth management officer, work with your financial advisor, work with Melissa. Think about how this will impact
Yeah.
the world, and it will direct your decisions for sure.
Well, and in a perfect world too, I mean, when we do 1031 exchanges, I mean, one of the first questions I ask is, who is your CPA? And some people, they have one of two people. There's a CPA who sends tax information to the government, but then there's an actual tax strategist who looks at things and determines the implications for this, that, and the other thing. And that's who we want to talk to, is we want to make sure that the CPA is an actual strategist who understands real estate and can engage with us in a conversation of and really pontificate all the what ifs and how about this scenarios.
Yeah. Yep.
So, and it's great that we have this tool at our disposal for sure.
I mean, that's a good point, Melissa. It's probably worth camping on that for a second, because I do think we at times have over realistic expectations for the role that our CPA should play on the strategy side.
Yeah.
And so having that conversation, you know, respectfully and gently, and saying like, hey, can you help me think through this strategically? And there are CPAs who just simply would say like, that's out of scope from what we do, you know?
That's fair.
And there are, and that is fair, you know, and it's just, it's good to know who we're speaking with. I think, you know, there are ways to get great advice from a tax strategist who, without firing your CPA, you know, so you can find, you know, you can find both of those pieces. But don't expect too much out of, you know, and same to be said for your financial advisor. You know, we work with a ton of different financial advisors who have different expertises, different scopes, different approaches, you know, and it's most of the time, I would say, you know, it's the exception where we find a financial advisor who has a really deep understanding of real estate, and especially of a local market of real estate that you're either selling or buying. And that's where I think you need to bring, you know, a Melissa or a John into the conversation to help them evaluate the real estate side, still with the lens of the tax strategy, with the estate planning piece, with the legacy planning piece. But again, like, don't expect too much, and don't, I say that in a respectful way. Like, let's all figure out how we work together in our areas of expertise.
Absolutely. Yeah, and I love that you don't replace a financial planner. I mean, you come in and you know, you guys focus on what you specialize in. What you specialize in. I need more coffee.
Yeah. Well, I mean, and oftentimes we'll become great friends, right? I mean, we're all of us, this whole sphere of people who are working on this project, they all tree up into the same motivation and incentive. Like, we're serving the same client who's trying to achieve like a specific set of goals and objectives. And so we will be aligned. And as a result of that alignment, I think you can really maximize the potential of that team by including all of us in the conversation. Absolutely.